What just happened to silver? Why everyone's talking about it today. January 16th, 2025. Mark this date. Not because of speculation, but because the mathematics just crossed a line that cannot be uncrossed. For 45 years, silver has been trapped below its 1980 peak, while everything else exploded higher. Real estate, up 500%. Stocks, up 1,000%. Even gold made new all-time highs. But silver? Still sitting at $30 when it hit $50 in 1980. The question isn't whether it will move. The question is, when the world realizes what's already gone, what happens next? The inventory is bleeding, the demand is locked in, and the paper market is about to meet reality. What you're about to hear will change how you see the next 12 months. Welcome to John Analyst. If you've made it this far in life, you've seen markets rise and fall, you've watched currencies lose their value, while governments promised stability, you've probably learned that the most important information rarely makes the evening news. That's exactly why this channel exists. We don't chase headlines, we analyze patterns, we study history, and we connect dots that others refuse to see. Now, if you value this kind of serious economic analysis, the kind your financial advisor won't tell you, the kind that requires experience, not excitement, do me a favor, hit that subscribe button. Not for entertainment, but because knowledge like this doesn't come from the mainstream. And before we continue, I'm curious, where in the world are you watching this from right now? Are you in North America, Europe, Asia, or somewhere else entirely? Drop your location in the comments. I want to know how far this message is reaching, because what's coming affects every currency, every market, every person holding paper wealth. Now, let's get into what actually happened on January 16th, and why the silver market is about to do something most people think is impossible. There are moments in financial history that look ordinary until they are not. January 16th, 2025 is one of those moments. On the surface, nothing dramatic happened that day. Markets opened, traders placed their orders, silver traded around $30 per ounce, just like it had for months. But beneath the surface, something fundamental shifted. A mathematical threshold was crossed. Not a prediction, not a theory, but a point of no return that most investors will never see until their screens show a price they do not recognize. Veteran market analysts, the ones who have watched cycles repeat for decades, understand something crucial. The best opportunities in history never looked obvious when they appeared. They looked lonely, they looked foolish, they looked like professional suicide. That is exactly where silver sits today. Consider the pattern. In the late 1970s, silver began trading around $6 per ounce. Nobody was paying attention. The metal had been forgotten, dismissed as irrelevant. Then, in a matter of months, it exploded to $50, not gradually, violently. Fortunes were made by those who positioned early, and lost by those who chased the move too late. Fast forward to 2008. Silver collapsed along with everything else during the financial crisis. Then it entered what market historians now call the most boring decade in its 5,000-year existence. While gold captured headlines, while cryptocurrencies dominated conversations, silver sat in silence. An entire generation of investors grew up never witnessing silver move. They assumed it was dead, a relic, something their grandparents collected. That assumption is the setup. Here's what took experienced analysts 40 years to truly understand. When an asset becomes so ignored, so forgotten, so universally dismissed, that is when the turn happens. Not when everyone is excited, not when the news is covering it, after everyone has given up, after the last analyst stops writing reports about it, after the price has done nothing for so long that watching it feels like punishment. Silver today trades around $30 per ounce. In 1980, 45 years ago, it hit $50. Think about that for a moment. 45 years of inflation, 45 years of currency creation, 45 years of economic growth, and the price is still below where it was in 1980. There is no other major asset class on Earth with that profile. Real estate has increased by over 500% since 1980. Stock markets have risen more than 1,000%. Even gold has made new all-time highs above $2,000 per ounce. But silver still sits under its 1980 peak. This is not normal. This is not sustainable. This is what market professionals call an asymmetric setup. When the fundamentals scream one direction, but the price whispers another. When logic is overwhelming, but the crowd refuses to listen. When history hands out a clear roadmap, but the world throws it in the garbage. Now, add the current economic backdrop. Global government debt has crossed $100 trillion. That number is so enormous, it has lost all meaning to most people. Nobody can comprehend it, nobody can repay it, and nobody in power has any intention of trying. The only solution governments have used for 3,000 years is the same solution they are using now. Debase the currency, print more units, make the debt smaller, by making the money worth less. This is not conspiracy theory. This is arithmetic. Every major central bank on the planet is trapped. They cannot raise interest rates high enough to control inflation because the debt service would collapse their own governments. They cannot cut rates low enough to stimulate growth because inflation is already destroying purchasing power. So they do what bureaucrats always do. They stall. They speak in careful language. They print quietly and hope the public does not notice. Meanwhile, silver sits at a price that would have been considered absurd 20 years ago when adjusted for all the currency units created since then. The United States government alone holds $36 trillion in federal debt. Interest payments exceed $1 trillion every single year. That number grows every quarter. The deficit is not shrinking. It is accelerating. They are borrowing money to pay interest on money they already borrowed. This is not fiscal policy. This is a mathematical impossibility dressed up as governance. And silver, the metal that has served as money for longer than most nations have existed, is priced as if none of this matters, as if supply and demand do not apply, as if monetary history can be ignored. That contradiction is the opportunity, because markets do not stay irrational forever. They correct. And when they correct after decades of mispricing, the move is not gradual, it is violent. It is the kind of move that turns portfolios upside down overnight, the kind that forces financial news anchors to scramble for explanations, the kind that makes analysts who missed it look foolish. History shows this pattern clearly: prolonged neglect, structural underinvestment, a narrative so dominant that people stop questioning it, and then reality reasserts itself, not politely, brutally. Silver has been neglected for so long that an entire generation believes it is boring, that it is outdated, that it belongs in a museum. That belief is exactly what precedes the biggest moves in market history. January 16th is not just another date. It marks the moment when certain numbers crossed thresholds that cannot be uncrossed. The professionals who understand supply chains, who track physical inventory, who study monetary systems, they are not talking about it publicly. They are simply positioning. Quietly, deliberately, because they have seen this movie before, and they know how it ends. There's a difference between scarcity and extinction. Scarcity can be solved, extinction cannot. Right now, the global silver market is not facing scarcity. It is facing something far more dangerous: structural disappearance. Every year, approximately 70% of all silver mined vanishes into industrial applications, not temporarily, forever. It gets embedded in solar panels, welded into electric vehicles, soldered onto circuit boards, integrated into medical devices. And here is the critical part most investors miss. These applications are not recycling friendly. When a solar panel reaches the end of its 25-year lifespan, it does not get melted down for its silver content. It gets thrown into a landfill. When a smartphone becomes obsolete, the microscopic amount of silver inside stays inside. Nobody is recovering it. It is economically impossible. The silver that disappears into these technologies is gone from the available supply forever, scattered across rooftops in rural China, buried in landfills across Europe, embedded in decommissioned military hardware. This is not a temporary imbalance. This is permanent removal, compounding every single year. Now, let's talk about where silver actually comes from. Global mine production has been flat for over a decade. Approximately 800 million ounces per year, not growing, not responding to price signals, just stuck. Why? Because the easy silver is gone. The massive deposits discovered in the 1970s and 1980s have been exhausted. The new projects are smaller, deeper, lower grade, and far more expensive to develop. But it gets worse. The countries that hold the remaining silver reserves are becoming increasingly unstable. Peru, one of the world's largest silver producers, is drowning in social unrest. Communities are blocking mine access. Environmental protests are shutting down operations for months at a time. Mexico, another major producer, is moving toward resource nationalism. The government is signaling it wants more control, more revenue, more restrictions. Bolivia, with some of the richest remaining deposits, is a political earthquake zone. Leadership changes every few years. Policy is unpredictable. Foreign investment is treated with suspicion. These are not temporary political problems. These are structural barriers that will take decades to resolve, if they ever do. And the mining companies themselves, they are not helping. Instead of exploring for new deposits, they are buying back their own stock. Instead of investing in long-term production capacity, they are paying dividends to shareholders. Why? Because building a new silver mine takes 10 to 15 years from discovery to first production. Permitting alone can take 5 years. Environmental impact studies, community consultations, regulatory approvals, The timeline keeps extending. The costs keep rising. And the major miners have decided it is not worth the risk, so production stays flat, while demand explodes. Let's be specific about the demand side. Solar panel installations consumed over 150 million ounces of silver last year. That number is growing by double digits annually. Why? Because every government on the planet has mandated a green energy transition. This is not market-driven demand. This is policy-driven demand, locked in by subsidies, tax incentives, and international climate agreements. Electric vehicles require silver for their battery systems, their charging infrastructure, their internal wiring. As EV adoption accelerates, so does silver consumption. 5G networks require silver for their signal transmission. Every new cell tower, every upgraded antenna, every expanded coverage area, medical technology relies on silver's antimicrobial properties. Surgical instruments, wound dressings, diagnostic equipment. Military applications use silver in radar systems, missile guidance, electronic warfare. None of these uses are optional. None of them can be substituted easily, and all of them are growing. Now here is where the mathematics become terrifying. For the past 3 consecutive years, the silver market has been in deficit. Demand has exceeded supply by over 700 million ounces. 700 million ounces had to come from somewhere. That somewhere was existing inventory. Stockpiles that were built over decades. Reserves held in vaults that everyone assumed would last forever. They are disappearing. The London Bullion Market Association, one of the largest silver storage facilities on Earth, reported a 30% drop in holdings over just 2 years. 30% gone. Shipped to India, shipped to China, shipped to industrial consumers who actually need the physical metal. The COMEX registered inventory, the metal that backs futures contracts, has fallen to levels not seen in decades. The vaults are being drained, and the market pretends not to notice. Why? Because paper markets create an illusion of liquidity, an illusion of supply. Traders buy and sell contracts representing silver without ever touching actual metal. For every physical ounce, there are dozens of paper claims. Some analysts estimate hundreds of paper claims per ounce. Nobody knows the exact ratio because the system is designed to obscure it. But here is what cannot be obscured. Physical silver does not lie. A solar panel manufacturer cannot install a futures contract on a rooftop. An electric vehicle producer cannot wire a battery with a paper promise. An electronics company cannot solder a derivative onto a circuit board. They need real metal, and they are taking it faster than the Earth can produce it. The gap widens every year. The deficit compounds. The inventory bleeds out. And one day soon, someone with deep pockets will demand delivery. The vault will open, and the metal will not be there. That is when the paper price meets physical reality. And when that happens, the correction will not be measured in percentages. It will be measured in multiples. There's a secret hiding in plain sight. A secret so obvious that the entire financial world has forgotten it exists. Silver is money, not was money, not used to be money, is money. For over 5,000 years, silver has been the most widely used form of currency in human history. More people, across more cultures, in more places, have used silver as money than any other substance on Earth. Gold gets the headlines, gold gets the respect, gold sits in central bank vaults and gets reported on balance sheets. But silver? Silver was the money of the people, the coins in their pockets, the wages they earned, the savings they buried under floorboards. And the evidence of this is still embedded in language itself. In French, the word for money is argent. That is also the word for silver. In Spanish, plata means both money and silver. The same is true in dozens of languages across the world. Hebrew, Swahili, Welsh. The linguistic memory remains, even though the financial memory has been erased. This is not ancient history. This is biological memory, encoded in the words people still use every single day. But here is where the opportunity lies. And the market has completely forgotten. Gold trades at a premium because the world remembers it is money. Central banks hold it. They accumulate it. They report it as a strategic reserve. The market prices gold as a monetary asset. But silver? Silver is priced like tin, like copper, like zinc. Just another industrial input with costs, margins, and quarterly earnings reports. The market treats silver as if its 5,000-year monetary history never happened. As if the billions of people who used it as currency were irrelevant. As if the fact that more human beings trusted silver as a store of value than gold does not matter. This is the mispricing. This is the structural opportunity that appears once in a generation. Now let's talk numbers. The gold to silver ratio currently sits near 90 to 1. That means it takes 90 ounces of silver to buy 1 ounce of gold. Think about that. 90 ounces of one metal to to purchase 1 ounce of another. The historical average over the past century is closer to 50 to 1. In the Earth's crust, where both metals are mined, the natural ratio is approximately 15 to 1. There is 15 times more silver in the ground than gold. But the price ratio says silver is 90 times less valuable. That discrepancy is not based on supply. It is based on perception. And perception always corrects. History proves this. In 1980, during the last great precious metals bull market, the ratio compressed to 15 to 1. Silver did not just keep pace with gold, it outperformed by multiples. In 2011, during the post-financial crisis surge, the ratio hit 30 to 1. Again, silver moved faster and further than gold. The pattern is clear. When precious metals rise, silver does not just follow, it accelerates. It multiplies the gains. It becomes the high beta play on monetary fear. And right now, that ratio sits at 90 to 1, coiled like a spring, compressed for years, waiting for release. Now, let's connect this to what is happening in the real economy. Since the year 2000, the US dollar has lost over 40% of its purchasing power, not according to conspiracy theorists. According to official inflation data, 40% gone, stolen quietly through currency debasement. And since 2020 alone, the money supply expanded by 40% in just 2 years. 40% more dollars created out of thin air, chasing the same goods and services. That is not economic stimulus. That is dilution, pure and simple. The government is solving its debt problem the same way governments have solved debt problems for 3,000 years, by destroying the value of the currency. Right now, the United States federal government holds $36 trillion in debt. Every year, it pays over $1 trillion just in interest. Not principal, interest. And that number grows every single quarter. The debt is compounding faster than the economy can grow, faster than tax revenue can increase, faster than any politician is willing to admit. They are borrowing money to pay interest on money they already borrowed. This is not a policy. This is a Ponzi scheme with a flag on top. And every major economy is playing the same game. Japan, the European Union, the United Kingdom, all of them trapped in the same spiral. All of them hoping the music never stops. But it always stops. It stopped in Rome when they clipped the silver content from their coins until there was nothing left. It stopped in Weimar Germany when people carried wheelbarrows full of paper marks to buy bread. It stopped in Argentina, in Zimbabwe, in Venezuela. When the zeros multiplied faster than printing presses could run, the pattern is always identical. Governments spend more than they collect. They borrow the difference. The debt compounds until it cannot be serviced honestly. And then they inflate. They do not announce it. They do not apologize for it. They simply create more units of currency until the debt becomes manageable in nominal terms. The debt gets repaid, but in confetti, in purchasing power that has been quietly stolen from every worker, every saver, every retiree who trusted the system. And here's the final piece. Gold is already priced as a hedge against this. Central banks know it. Investors know it. The market knows it. Gold has made new all-time highs because it is recognized as monetary insurance. But silver? Silver sits at $30, below its 1980 peak, priced as an industrial commodity, completely ignored as a monetary asset. This is the opportunity, not because silver is unknown, but because it is known and still dismissed. The world has forgotten what silver is, but the market is about to remember. And when it does, the repricing will not be gentle. It will be violent, fast, and utterly unforgiving to those who waited too long. The ratio will compress, the price will multiply, and the crowd will act shocked. But the pattern was always there, written in history, embedded in language, visible to anyone willing to see it. Markets do not break when everyone sees the problem. They break when the problem has been invisible for so long that nobody believes it exists anymore. And right now, in the silver market, that breaking point is approaching, not in theory, not in some distant future, right now. But to understand how this collapse will unfold, one must first understand the difference between two worlds, the paper world and the physical world. In the paper world, silver trades freely, contracts change hands by the thousands every day. Traders buy, traders sell, liquidity appears endless, prices move smoothly on screens, everything looks normal. But in the physical world, something very different is happening. The metal is disappearing, silently, systematically, permanently. Here is how the paper market works. For every ounce of physical silver that actually exists in a vault, there are dozens of paper claims. Some analysts estimate hundreds of claims per ounce. Nobody knows the exact number because the system is designed to hide it. These paper claims trade as if they are real metal. Futures contracts, options, exchange-traded funds, unallocated accounts. All of them represent silver. None of them require actual delivery. This creates an illusion of supply, an illusion of liquidity, an illusion that everything is fine. But physical metal does not trade on illusions. A solar panel manufacturer cannot install a futures contract on a rooftop. An electronics company cannot solder a derivative onto a circuit board. An industrial consumer cannot accept a promise when their production line needs metal. They need real silver, and they are taking it faster than anyone realizes. The London Bullion Market Association vaults, once filled with hundreds of millions of ounces, have bled out over 30% of their holdings in just 2 years. Where did it go? Shipped to India, where demand for physical silver has exploded. Shipped to China, where industrial consumption continues to grow. Shipped to manufacturers who cannot afford supply chain disruptions. The COMEX registered inventory, the actual metal available for delivery against futures contracts, has dropped to levels not seen in decades. The vault doors open, the shelves get emptier, and the paper market continues trading as if nothing has changed. This is the disconnect, and this disconnect always ends the same way, violently. Let's look at history. In 2022, the nickel market on the London Metal Exchange collapsed, not because of a surprise, but because someone demanded delivery, and the metal was not there. The exchange had no choice. It halted trading. It canceled contracts. It rewrote the rules in real time. Billions of dollars in positions erased overnight. The same thing happened in agricultural markets. Storage reports showed grain supplies were abundant, but when buyers came for physical delivery, the grain was already gone, sold, shipped, consumed. The paper said one thing, reality said another, and reality always wins. Silver is heading for the exact same collision, but here is what makes this even more dangerous. The people who understand what is happening are not talking about it. They are acting. Central banks in Asia are quietly adding silver to their reserves, not through public announcements, not through press releases, through quiet purchases, private transactions, unreported accumulation. Wealthy families in Europe and the Middle East are taking physical delivery, moving metal out of the banking system, into private vaults, into personal storage. Industrial users are building strategic stockpiles, not because they want to, because they have to. They cannot afford to run out of silver in the middle of a production cycle. They cannot risk waiting for the spot market to deliver. So they are hoarding, quietly, deliberately. And none of this shows up in the news. None of this moves the paper price. But all of it drains the available physical supply. This is how the gap grows. Paper traders look at charts and see a boring market going nowhere. Physical buyers look at vault inventories and see a crisis approaching. Both perspectives cannot be correct. And the paper traders will be the last ones to know. Because when the inventory finally hits zero, when someone with deep pockets demands delivery and the metal is not there, when the exchanges face the choice between default and explosion, that is when everything changes, not gradually, not with warning signs, instantly. The paper price will gap higher, not by 10%, not by 20%, by multiples, 2 times, 3 times, possibly more, all within a matter of days or weeks. The move will not make sense to anyone watching from the outside. Analysts will scramble to explain it. News anchors will call it manipulation. Regulators will launch investigations. But the truth will be simple. The paper market ran out of physical metal, and the price had to adjust to reflect reality. This is not speculation. This is pattern recognition. This is what happens every single time, when paper abstractions diverge too far from physical constraints. The correction is always violent. The repricing is always shocking. And the transfer of wealth is always brutal. Those holding paper promises will be left with nothing. Those holding physical metal will be left with everything. The window to position is still open, but it is closing. January 16th, 2025 marked a threshold. Certain numbers crossed a line. Certain inventories dropped below critical levels. Certain buyers began accelerating their purchases. Most people will not notice until their screens show a price they do not recognize. By then, it will be too late to act. The metal will be gone. The vaults will be empty. And the only question left will be, why did nobody see this coming? But the professionals did see it. They saw it years ago. They just did not waste time talking about it. They positioned. They accumulated. They moved their wealth into hard assets while paper still had value. And now, they are simply waiting. Waiting for the market to remember what silver is. Waiting for the paper system to break. Waiting for the repricing that always comes when reality can no longer be ignored. The mathematics are irreversible. The supply deficit is compounding. The inventory is disappearing. And the collision between paper and physical is inevitable. The only question that remains is simple. Will you be holding paper or metal when it happens? Because one of them will be worth everything, and the other will be worth exactly what it always was, nothing.